markets. You're taking a look at not a lot of action here. The market closes for the equities at 1 o'clock. Bond market closes at 2. A little bit of softness, maybe a little sogginess, but not going to see a lot of price action. To me, it's going to be about how everyone's positioned for the last month of the year. Well, joining me for the hour is Bloomberg's Romaine Bostick. Are you anchoring for like 9 hours today or something?
Well, somebody's got to be here, Alex. I wanted to be out there on Black Friday with the hordes.
You don't shop.
All of my money.
Not shop. That's totally untrue.
I bought a pair of shoes this morning.
You did?
I did, online.
Okay, all right.
65% off.
I have my whole... Where'd you buy it?
I'm doing my part to help the economy.
Where'd you buy
Alex.
it?
This is from Neiman Marcus.
Oh, yeah, the fancy ones, of course. Yes. Do you have a good Thanksgiving?
It was a wonderful Thanksgiving. How about yourself?
Good, good.
Yeah.
I did all the cooking, and then my husband made cranberry sauce. So here I have like all this stuff, and he's like, look at what I did.
Well, I made cranberry sauce too. So thank you. Men unite. All
right. We're just about 4 weeks away. What is it with you guys and cranberry sauce? All right, 4 weeks away from 2020. Investors are really bracing the new year and what it has in store.
Our economic outlook has gotten better.
What's important within that trend, now that we're stabilizing, there's more positives within the stuff that matters to markets.
The near-term path for global growth is actually up. Most risky asset markets and even rates markets to a certain extent have front-run that.
The overall growth outlook for the global economy, we think, is relatively stable, but we don't share the near-term optimism of the IMF.
Today, I think we're sitting in a place where the risks are significant and not reflected in the valuations.
We just don't see a lot of reason to believe that turn in the cycle is going to be particularly strong.
We're in a sluggish economy, but this downdraft is probably behind us. The economy is going to be a bit more sluggish. Earnings are going to be weakish.
We think U.S. equities will be an underperformer next year. They'll be an underperformer because the earnings trends will be weaker.
Potentially, we're still going to be locked in a trade war with tariffs, which potentially means higher yields and an economy that is slower.
What's really bothering me is I don't necessarily see this big reacceleration coming either.
Stocks are going to do really well on weaker growth, and we're all going to be left scratching our head, and I think that's the way it's going to play.
We debate when the end of the cycle is coming, what's going to push us there, how long is it going to last. I mean, honestly, that's a depressing thought to me.
Joining us now, Kathryn Rooney Vera, Baltic Head of Research and Strategy, and in London, Seema Shah, Principal Global Investors and Chief Strategist. Great to have you both with us here. Kathryn, I never get to see you in person, so this is really fun. What is your top conviction call for 2020?
Well, look, I think it's going to be a stable economy. I agree with the herd mentality, which has shifted, Alex, because only 6 to 12 months ago it was completely the opposite, right? It was recession for 2020. Recession is imminent, if we're not already in it. So I do think that we're going to see a stable and above trend and above potential growth year for the U.S. economy.
Are you not concerned that maybe the market's gotten a little bit ahead of itself, though? I mean, when you look at some of the valuations, when you look at how far we've come since roughly like the end of September, 11–12% on the S&P 500.
Absolutely.
Are we pricing in too much?
Romaine, there's two different scenarios, right? There's the real economy, which is strong. Then there's the market pricing. I completely concur. I think the markets have gotten way ahead of themselves, which is the reason why I'm actively, to anyone who will listen, recommending a put option with March expiry. It costs you a little bit above 3% of your returns, and you protect yourself through, what, 2 Fed meetings, any negative surprises from the Democratic primaries, and any fallout from the December 15th tariffs on China, which are still in the offing.
Yeah. So, Seema, jump in here. I mean, for all of the optimism that we have now that the economy, both in the U.S. and globally, may avoid some of the worst-case scenarios, there are still some overhangs there with the 2020 election here, with Brexit in the U.K., and some concerns still in Europe. When you kind of factor that all in, where do you really want to be positioned here?
So it's a difficult market at the moment. As you said, valuations are so expensive across so many different asset classes. It's difficult to find where there is still any kind of value. But I think the areas to think about is, we like Europe increasingly, although, of course, there are still concerns whether or not Germany's even going to introduce any fiscal stimulus. We continue to worry a little bit about Brexit. But we also like emerging markets. We think there's still some value there. But increasingly, equities, we're looking about, for the S&P 500, only about 0 to 5% returns. Very little in the credit space. You're almost looking at alternatives, and we're thinking real estate is our favorite pick, really.
Well, what I'm also interested in is sort of the range and outcomes for next year. And Seema, I want to show you this chart if you can see it. It's the S&P and sort of the high end and the low end of strategist estimates. I mean, we're ranging almost like 100 points. It basically tells me that no one has any idea what's going to happen next year, and to then position yourself makes it much more difficult.
Yeah, and I think that's really key here, because I think a lot of the positive forecasts out there are resting on the assumption that there is going to be a partial trade deal. If that partial trade deal doesn't come through, then you're looking at potentially a very, very different perspective. And on top of that, because you've had most of the movement in equities really been driven by a multiple expansion, not really on as much stronger underlying economy, that if things go wrong for any reason, then you could see a very quick unraveling of equity markets. So I think that's why you're seeing such a huge dispersion across those forecasts.
Yeah, and Seema's right. I agree with that in the sense that next year, bank on volatility. Bank on both any negative catalysts from the political sphere, whether from you know, a very left-wing person from the Democratic Party who could come in and take the nomination, or from some fallout from the impeachment process. A lot of it is already, you know, priced in, but there is volatility. You have to protect yourself and protect your accumulated return in front of this downside. So one of the ways Seema mentioned is alternatives. I agree with that. Building up your cash position, buying options to protect yourself. These are ways that you don't have to buy into this herd mentality of the markets are going higher forever.
But talk about that herd mentality, because, I mean, one thing about the rally we've had over the past few months, it has been concentrated in a lot of those large mega cap names. We've seen some outperformance from some other companies as well, but it's still, you know, the Apple, Microsoft, United Health, that sort of, you know, 4 or 5 companies. Does that make it, does that create a little bit more risk that should that unraveling that Seema mentioned, it is worse than?
Undoubtedly, Romain, and you really nailed it with that comment, because the recent upside that we've seen above 3,000 and above 3,100 on the S&P 500 is almost exclusively tied to tech shares rising. So yes, a market that's based on one sector or 3 stocks is vulnerable to downside in those sectors and in that stock. So I would be very careful at current levels.
So Seema, you know, a lot of folks are looking to sort of, I guess, protect themselves. I mean, Kathryn was talking about doing it through options. Obviously, you can also do it just through kind of, I guess, picking the right stocks. You mentioned real estate. Are there any other sort of, I guess, defensive or defensive-like areas that you would say would be a good place to look to as we head into 2020?
Yeah, I guess, you know, one of the areas that we still, like you mentioned it, we still like mega caps. It's almost a barbell strategy that we're looking at. So you maintain your overweight to mega cap, maybe reduce the large caps area, but also play a little bit with the small caps, because if you are going to get a slight upturn, and we do believe that there's going to be a very sluggish upturn next year, so no recession, that means that small caps, given where valuations are, could outperform. But it's really about protecting as well as trying to be plugged into the market. So if there is an upturn, you can still benefit.
So where's the risk, though, there, Seema, in particular when you talked about alternative assets? Because it feels like, and Kathryn has the same call, like the more you go into alternative assets, if you have players in the market who don't understand it, and not you, but I'm talking more retail, what do you do? How liquid is it? What's the risk?
Well, I think the key thing here is, you know, what we're trying to tell investors is that there is no reason to overreach for yield. You know, yields are really low, so there are other spaces. You don't need to go into the high yield space. But at least with the illiquid areas, at least you're getting a bit of a pickup. But this means that the key is global diversification across regions and also across asset classes. So by no means put all your eggs in one basket and just plow it all into real assets. But you also have to consider that that is where you're going to get a bit more upgrade. With real estate specifically, it tends to be more insulated from the kind of geopolitical shocks that you would have. So it's really, you have to pick the domestic economy, which is strong, and focus on real estate there. And so you're still getting that defensive positioning against all the risks, which is still very much present.
Yeah, there are risks, as you say, Seema, and I'm wondering what your view is with regard to negative interest rate policy and any bubbles that you see in the markets or across the markets engendered from negative interest rate policy, quantitative easing, even in Europe, where you're located, European central banks really pumping the markets, pushing investors out the yield curve, out the risk curve, potentially accumulating positions and risk that he or she should not be positioned in.
Oh, this is absolutely going to be the theme for 2020, we think. We look at the Riksbank, for example, which, they're walking away from negative policy rates because of this concern about having created an asset price bubble. In Europe, in Japan, it's also the case that they believe that negative rates have been generally counterproductive. In Germany, we hear signs that savings has actually increased. And that's partly because a number of people out there believe that negative rates, they're only going to get lower and lower. So you may as well defer borrowing. So almost you're weighing down on the economy. So we do think that actually the ECB, the Bank of Japan, there's not going to be further rate cuts next year. But that doesn't mean to say that you're going to get a massive sell-off in global bonds, because we still think they're going to keep expansion going, on the balance sheet. We think there's going to be a push for fiscal easing, but not very, very significant. But this is absolutely the theme for 2020.
So, Kathryn, in terms of protection, we have a viewer question. A lot of folks waking up on this post-Thanksgiving morning, watching Alex Steele on Daybreak. America's here. But in all seriousness, gold. We saw this sort of rally through most of the year. There was this idea that this was sort of a good form of protection, maybe another place to sort of park your cash. That trade's come off a little bit. How do you view that going into 2020?
Expect that long-term trend to continue, Romaine.
Yeah.
I think it's a good idea to position yourself in a real asset, even the physical aspect of gold. Because if we're right, and it seems that SEMA concurs with my theory that negative interest rate policy is a detriment, especially in the current markets. And we keep seeming to dig ourselves deeper and deeper. So to extend the economic expansion, or even to incite it, as the case is in Europe, let's just take negative rates a little bit lower. Maybe it'll work this time. Or let's do another round of QE. Regardless, and maybe unconscious of the negative repercussions that could come to the fore over the coming years. So I do like the gold trade. I think you should expect gold to go higher.
All right, Kathryn Rooney Vera of Baltic and Seema Shah, Principal Global Investors. Guys, we love you on this Friday. Thanks for sticking with us. And coming up, it is what was once the world's fastest growing economy is now slowing down. We're going to break down India's sputtering growth next, the lowest in 6 years, and how to position in emerging markets. This is Bloomberg. India's growth is slowing down. So the economy grew at its weakest pace in 6 years, and businesses are holding back because of some bleak prospects. So what do you do? Still with us, Kathryn Rooney Vera of Baltic and Seema Shah of Principal Global Investors. It's not just India that's doing monetary and fiscal stimulus. It's all over emerging markets, particularly Latin America. Where do you like investing in EM?
Look, emerging markets is really becoming consensus. There's a lot of people that are saying go overweight emerging markets. And it's not a bad trade. Latin America is really slowing down and is prone to a lot of domestic tumult. As you can see in Colombia, Bolivia, Argentina, Mexico, everywhere there's kind of this turbulent political environment. I like emerging Asia, Chinese consumer discretionary, if in fact, and I think we will get a phase 1 trade deal, China consumption, I think, has further to run. So within the emerging market space, I would say let's look at China.
So, Seema, there's a consumption story here, but there's also an FX story. And one of the things that's held EM back for most of the year has been the strength of the dollar. When you overlay that on top of the opportunities there, how do you see it playing out next year?
Yeah, so I really think that's going to be key for emerging markets. We don't see much further dollar strength. I think that's the first thing to consider. And one of the reasons is that we do expect there to be that global stabilization in the economy, which should generally mean that you get a dollar weakness. But as long as you have treasuries kind of having that big pickup over other yields around the world and negative space everywhere, it's going to continue to attract capital. So we don't see much room for dollar weakness, but at least no movement up. And that does play well for emerging markets. But I totally agree with Kathryn on that. Latin America, there are spots there which we have to avoid, and emerging Asia for us is our favorite pick for emerging markets.
And so, Kathryn, you mentioned the kind of the fiscal side of the equation for some of these nations. Monetary policy-wise, some of these nations also have a lot more room to maneuver, at least compared to some of the developing countries.
Yes, and in Latin America, every major sovereign has cut rates with the exception of Colombia, which probably is going to as well. So there's the monetary aspect, but and this is not really popular nowadays. We're kind of all talking about monetary policy being the panacea for both growth and everything, right? Monetary policy is where it's at. What I've been pushing for, especially in Europe, and I'd love to hear Seema's views on this if she differs, is supply-side reforms, deregulation, tax code simplification, labor market flexibility. These are the things that incite real GDP growth, not negative interest rates, not quantitative easing, not even government spending. You can get a near-term spark from fiscal policy, but what you really need, especially in Europe and in Latin America, are these structural, at the core, fundamental economic changes.
But then, Seema, if you get that, like China's been trying to do that, then you get Moody's saying you're going to have more corporate defaults. You have a steel producer defaulting on its debt despite the fact that it just borrowed money. I mean, it's hard to do, and then it might not work.
Yeah, I think, and Europe is a perfect example of that. There are a number of countries which have tried to open up their labour markets, improve competitiveness and efficiencies. But, you go through a period of weakness for a number of years before you come up on the other side. And for governments who tend to be, of course, they tend to be short-termist, it's a difficult decision to make. The one thing I'd say is for Europe, the positive thing is that with Christine Lagarde, she's bringing in a lot of IMF policies into the ECB. So where she's pushing for fiscal policy, she's pushing for fiscal stimulus in investment into infrastructure. So hopefully we should see some movement, although I don't expect it to be enormous.
Well, that's a good point that Seema brings up, too, because when we talk about fiscal stimulus, I mean, different types of fiscal stimulus produce different types of results. And you do kind of wonder if there is, I think, what Lagarde seems to be pushing and what maybe you see in other countries, if that difference is going to end up with, I guess, different results.
Sure, there's current spending and there's capital spending. So, government transfers to welfare programs has a different impact than does capital investment, which is infrastructure with roads, bridges, etc. Germany, for example, has the space to do fiscal stimulus. So if we're looking within Europe, Germany is one country that I would say, look, if we do get a U.S.-China trade accord, Germany stands to disproportionately benefit because they are the export powerhouse of the region and of the world.
But no way that they do fiscal, Seema. I mean, right? You already heard even before you got that anemic growth in the third quarter, you had the finance minister being like, we don't want to do it. And then you have the unemployment is actually falling. So why would they even think about it now?
Absolutely. With you've got the Bund yield curve pretty much all negative. Why is the government not taking advantage of this perspective? I mean, I think there is a push for fiscal stimulus, but that push is going to be on the green side. I don't think it's going to be very significant. And, Kathryn, as you said, if there is a deal in play between the US and China, Germany really stands to benefit. But the irony is that means that they're less likely to go ahead with a fiscal stimulus, which arguably they need more than the US-China trade deal. So, unfortunately, although the prospects for Germany and the rest of Europe, I think, are more positive than what many people are expecting for next year, I don't think it's going to be anywhere close to kind of a 2% growth rate in that area.
Yeah, you're right. And I think that if we get some trade accord, Germany doesn't need the fiscal stimulus. But it's also a good time to enter the markets in Germany. You have the entire yield curve negative. Germany on the cusp of recession. All of that is currently baked in. Europe has done pretty well so far this year, but there could be some room for upside. So I would look in that space.
All right, Kathryn Rooney Vera of Baltic and Seema Shah, Principal Global Investors, are sticking with us. Coming up, we're looking at the European job market after Daimler says it's going to be cutting about 10,000 jobs. This is Bloomberg. Much, Viviana. So, I have a chart that shows you the why. This might be my favorite chart today.
Okay.
Coming to Bloomberg, this is all the R&D for the major European automakers, and you can see how much it's increased in the last few years. Daimler is that blue line, and just how steep it's really been, and that is truly an EV story. Because you need to make the transition to EVs. It's ridiculously expensive. They don't necessarily have the technology to do it, and they got to put in the money now, or else they're going to be way too far behind.
Yeah, and it's interesting to see. I mean, this is really, you're going to see the winners and losers. It's really going to boil down to, I guess, not only how much money they spend, but whether they spend it well. And I think you see the cuts by Daimler. They're kind of late to the game here.
True.
I mean, GM obviously was pretty aggressive at doing this. Volkswagen to an extent as well. But if any of these companies are going to survive in the future, they've got to be leaner, and more importantly, they've got to divert that money towards electric.
Totally. Kathryn Rooney Vera of Baltic. So for you, I know you guys were talking about Europe before. How do you factor in something that is really structural that has nothing to do with trade? Yes, okay, the car issues is somewhat trade related, but the EV stuff, for example, not related.
Yeah, look, I think that, as Romaine said, the companies really do need to become leaner to continue to produce good earnings. You know, you have the top line and the bottom line. So companies have been generally very strong. We saw this last quarter come out negative, but marginally so. And going on into the future, they have to become leaner, they have to become smarter, more efficient. And with regard to Germany, look, I think that even if you get some incipient economic growth, you could have the major corporations in conjunction with some phase one trade accord really outperforming this next year.
Yeah, I think Volkswagen's paying like 50 billion euros in 5 years.
Yeah.
Something crazy like that. All right, Kathryn Rooney Vera of Baltic will be sticking with us. Coming up, it is the holiday shopping season officially kicking off with in the U.S. with Black Friday. Romain already bought something. Is he tapped out? Where are they buying it? How much are they buying? We'll break all that down next. This is Bloomberg. This is Bloomberg Daybreak. I'm Alex Steele. Happy day after Thanksgiving, everybody. We're having some fun on set. Okay, so not a lot of movement happening. It's a quiet, it's a soft trading day. S&P futures off by about 0.2%. It's similar in the FX market. You did wind up getting better data, actually, out of Europe. Inflation stabilizing at around 1% if you switch up the board. The euro, though, actually a little bit weaker. And the spread here in the U.S. continue to hold around 14 basis points. Well, shoppers hunting for some deals headed to the stores this Black Friday, but many more actually heading online, crashing some sites from heavy traffic. We are joined by Kathryn Rooney Vera of Baltic, and Seema Shah joins us as well, a principal global investor. So, Seema, do you like retail? Do you like consumer discretionary?
Yeah, I think there's a lot resting on this. You know, this time of the year is so important for retailers. We know that the Fed has made things as easy as possible as they can for consumers. We have more concern for the retail companies because of those margins which are being compressed. But we would rest entirely for our forecast for next year on those trade tariffs on December the 15th. If they go ahead, we think that the forecast for retailers is going to be really negative. If they don't go ahead, then I think the market's going to love it.
So, Kathryn, I mean, look, I mean, the consumer is pretty much what kind of saved us, I think, from recession. I think a lot of people agree that was the case in 2019. But there's some concern that some of this is built on increase in consumer credit, consumer debt. Is it still at a level, with regards to the debt picture, household spending, is that still at a level where we can sort of be confident that the consumer spending trends will continue?
Well, yeah, if the Fed stays very low in
Sure.
terms of rates, and global central banks continue to keep rates exceedingly low, then the bubble doesn't burst. But of course, across the board, from the U.S. consumer to the Brazilian consumer to corporates to sovereigns, everyone has taken out debt.
Yeah.
It makes sense. Rates are very, very low. So my concern is that when inflation comes back, and I think a misconception globally in the markets is that inflation as an economic phenomenon is dead and buried. When it does come back, we're going to see some pain.
But here, this chart is what's confusing to me, because it looks like the health of the consumer has only gotten better when it comes to housing, because they've been able to refi at low rates, versus that orange line, which is overall consumer debt service ratio. At what point do you get nervous, Kathryn?
I get nervous when we start to see inflation come back, because that's when rates are going to go higher, because the Fed, the ECB, is going to eventually have to come off of negative deposit rates, BOJ. The Fed is going to have to hike rather than cut. I think the Fed stays on hold the entirety of 2020. But if, in fact, inflation at some point does eventually come back, which it is supposedly a monetary phenomenon at the end of the day, then you will see some pain. You will see corporates that have over-levered themselves, have difficulty repaying their debt obligations. You will see consumers that have indebted themselves too much, have difficulty in coming back. So I think a lot is tied to global central bank interventionism, proactive, monetary policy. That's where I put a lot of the problem here. And a lot of it, Alex, and not to sound too alarmist, is that it reminds me kind of the last crisis that we had in 2008, when it was like, you would hear guys say, oh, the markets are just going to keep going higher, real estate is just going to keep going higher. Now the level of complacency, Romain, in the markets is incredible.
Yeah, I remember those days before the crash. So for more on retail, we're joined by Stacey Widlitz, SW Retail Advisors President, joining us also from London. Hey, Stacey, what's your early read on Black Friday, which is also now spreading to Europe?
Yeah, so Black Friday so far, certainly the online numbers for yesterday look like they're about up 20%. Of course, you know, Black Friday now is on Thanksgiving Day, and in many cases, Black Friday has been moved weeks and even in some cases a month before the actual day today. So, you know, where it's at is the growth online, up 20%. You know, that's pretty much in line with what we've seen for most of the retailers that have reported already.
So, but when you take a look at what's going on, Stacey, here, I mean, obviously we know that this time of year the spending levels are typically higher, but so are the discounts. And I'm wondering from the retailer's perspective, does this end up being truly a profitable period for them if the discounts end up being too heavy?
For some, yes, and for some, no. So, you know, Black Friday, first of all, is now global. It's everywhere. It's in Germany. Well, France is trying to get rid of it. It's in the UK. It's all over. And I think everybody is under pressure to kind of meet what the neighbors are doing. So 20% off is the basic bar. You're still making money at that, but then there are others out there like The Gap and Old Navy and Victoria's Secret who are 40, 50% off the entire store. That's a harder proposition here when you're looking at bottom line profitability.
And so, I mean, we're showing pictures here of folks, you know, hanging out in the stores, doing their thing. But, I mean, the brick and mortar experience, it isn't quite what it used to be on Black Friday where people would just sort of crush through the doors. Now everyone just wakes up in the morning and goes onto their computer, right? Or some people.
Exactly. So now, you're right. It used to be, you know, line up Thanksgiving night, 5 o'clock, and some people still do that and crash through the doors. But now it's just a more extended period. And of course, retailers are making it so easy to go online, and then you can pick up your product a few days later in stores if you feel like it, rather than having it delivered. And guess what? That's a win-win for the consumer and also for the retailers, because that transaction, if you pick it up in store, is the most profitable one for retailers. Nordstrom talked a lot about gaining share in that, and Target is probably the one doing the best in terms of getting the consumer to pick up that digital order so those gross margins are higher.
I want to get your take, Stacey, because we've seen also the rise of rental clothes, and it's not a new story, but what does feel new is that actual brick and mortar stores like H&M are now doing that. And overall, you've seen a trend of people just not owning clothes for longer, so they're not going to want to go out and buy them, therefore they rent it. How does that play into the changing retail world?
I think that is going to be a huge issue going forward. I think millennials and Gen Zs have made it very clear that sustainability is key for them in purchase decision making, and they don't see the need to pack their closets with permanency. Rather, they're going out and renting, and because of the success of Rent the Runway, a lot of the retailers are doing it themselves, which is a tough concept because the inventory management is very difficult, but a lot of them are fulfilling it through a company called Castle. So I think that's the future, and actually could represent up to 20% of apparel sales going forward and eat into that business. So definitely keep that on your radar.
So also, Stacey, when you take a look at the discounts that we've been seeing at certain retailers, you know, such as Gap, which seems to sort of be in this sort of perpetual state where it always has to offer a discount in order to get people in the stores. How do some of these retailers sort of rebound once you get back into January and February and you know, where presumably they would have to go back to a more of a full price model? Are they still going to be able to get people into the stores or onto their sites?
That's a great question, because some of these retailers that you've seen, like a Victoria's Secret, like The Gap, they have been on perma promotion for years. And, you know, so like 50% off today is not exactly like the biggest deal in the world for a Gap. It's one of their highest, but it's not like this never happens. So I think for them, they have really trained the consumer never to pay full price, and it's very difficult to walk your way back into full price from that. But for other retailers like a Target, they have done an amazing job with private label and being differentiated and redoing their stores. So they can have promotions today, but then they're going to get those consumers to pay full price later because the product is truly differentiated and value-oriented.
Stacey, thank you so much. We really appreciate this perspective and the forward-looking look for retail. Stacey Woodlitz of SW Retail Advisors. Great to see you as well. Hey, Seema, we were talking earlier about consumer discretionary and retail. I mean, is there a derivative play to be had if you still want to be playing the consumer, but you don't want to go into this space?
Yeah, I mean, look, if you want to play the consumer discretionary, but you're really worried about those margins, then you just need to find a different sector which is going to be plugged into the cyclical side of the economy. And, you know, we actually, you know, some people kind of will be confused by this, but we really do we think that there's some opportunity in financials, mainly US financials, not European. And we still like technology. You know, the FANGs, they are very, very expensive, but there are other parts of technology, mainly in the kind of the structural parts of technology, which we think will do well if there is an upturn, even if it's a sluggish one.
So Seema makes a good point, Kathryn. I mean, if you really do want to play into consumer trends, you don't necessarily have to go in and buy a Gap or a Nordstrom. There are other ways to do it. What are some of those areas that you think we can do that?
Yeah, look, online retail, just for the toy market, Alex and I both have, you probably have children as well, a quarter of toy purchases are now online, so it's just much more convenient. One thing that I will add, Romaine, that I think that a lot of people are probably concerned about is the December 15th increase on tariffs. So we're talking about the tariffs covering the totality of Chinese imports, which could impact electronics, iPhones, laptops. One thing that I will tell the consumers that could be worried about this in the holiday season is that the inventory has already been imported for this year. So you don't have to worry about it. Right. This year inventory for sale has already been brought in. So the tariff impact, were they to go through December 15th, will not take impact this year. Rather, it would be something for 2020, and the holiday season starts right around the time of the presidential elections, which should make some some interesting times.
All right, guys, thanks so much. Really appreciate it. Kathryn Rooney Vera of Baltic. Seema Shah, Principal Global Investors. Great to see you. What we didn't get to, Romaine, is like, how do you rent H&M clothes? They're going to like fall apart after you buy them once. I mean, I don't understand. There's like no longevity.
A little bit above me. And it seems like the rental trend is more right now geared towards
designer
women and the market too.
True.
Although I guess you're starting to see some of the men's lines come into it, but
not H&M. I just don't quite understand it. All right, I'm going to give you